Hi everyone, we are now going to look at our two problems, P8-1B and P8-5B. And I thought I was on my page, but I wasn't, so just give me a second. So in P8-1B, we're looking at internal controls. I'm on page 319 of your book. The following are 5 separate cases involving internal control issues. So let's see what they want us to do. Requirement for each case, identify the principle of internal control that is violated and then recommend what should be done to adhere to principles of internal control in each case. So if Taiwan company keeps very poor records of its equipment, instead, the company asserts its employees are honest and would never steal from the company. Well, that's obvious. They must maintain adequate records. Must maintain adequate records. We'll come back to what they should be doing in a second. Marker Theater has a computerized order-taking system for its tickets. The system is backed up once a year. Bad move. Apply technological controls. That should be backed up at least daily, and there should be 2 separate backups. One somebody takes home and one stays on the premise or is stored off premise. Sutton Company has 2 employees handling acquisition of inventory. One employee places purchase orders and pays vendors. The second receives the merchandise. So separation of duties. Still need to divide the responsibilities for related transactions. So one person should order, one person should receive, and one person should pay the vendors. Well, we'll talk about that, right? The owner of Super Pharmacy on D uses a check software printer to prepare checks, making it difficult for anyone to alter the amount of a check. The check software printer, which is not password protected, is on the owner's desk in an office that contains company checks and is normally unlocked. Lots of safety issues there. We need to apply technological controls, including locks. To ensure the company retreat would not be cut short, the manager of Lavina Company decided to save money by canceling the external audit of internal controls. Well, no, we should be performing regular and independent reviews of the information. So what should they do to correct each one? Well, in one, with the not keeping records of the equipment, good record keeping helps protect assets from theft or loss and helps managers monitor company activities. Keeping poor records of its equipment leaves the company vulnerable to either misusing the equipment or theft. Hiring honest employees helps, but it is not a substitution for adequate records. The company should immediately update and improve its records of equipment. Further, these records should be updated regularly. So there should be a running list of all equipment and even identification on each piece. In the second one with Marker Theater, this company needs to start backing up at least daily. The company needs to change the backup policy of their system and make sure the backup copies are stored off premise, as I said, or on the cloud, even better. Sutton Company's handling of inventory. Well, the company needs to have 3 employees, and I talked about that already. I guess I kind of went ahead. It needs one to place the orders, one to receive the merchandise, and then one to pay the vendors. In the fourth one, the use of the software is a good internal control. However, the company needs to keep the checks and check software printed in a locked environment and password protected. And then finally, we need to conduct regular independent reviews of internal controls to ensure policies are being followed. Canceling an external audit of internal control exposes the company to risk that failing internal controls will go unnoticed. The company should cut expenses elsewhere and rehire the external auditors. Okay, so just some practice with these principles of internal controls and why they're so important. Okay, so now we're going to slide on over to problem 8-5B, which is our problem portion of this chapter. Shamara Systems recently reconciled its bank balance on April 30th and reported 2 checks were outstanding at that time. Check 1771 for $781 and check 1780 for $1425.90. check number 1780 was still outstanding as of May 31st. The following information is available for May 31st. So what this is saying is, last month, when we did our bank reconciliation in April, we had to check two checks that still were not cashed at the bank. So we got to keep that in mind when we go into our bank reconciliation for May. Let's take a look at the information they provide. The first part is the banking information. So according to the bank, which keeps track of our checking account, us being Shamara, we start with a balance at the bank of $18,290.70. We added $16,566.80 of deposits. We had checks and debits of $13,094.80, and the details of each of those totals are below. So the balance at the end of May 31st, $21,762.70. Our records, in our accounting records, indicate that on the right-hand side, there's our cash account. According to our account, we started at $16,083.80. We added $11,944.10 in deposits, and those are the debits. There's the total debit, and you can see there's our debit amount to the left, cash receipts deposited, and it has cash debited. There's about 5 of them. According to our records back at the company, there were $12,850.60 in checks, or I should say credits, decreases to our cash account. And you can see right to the left, all those cash payments, all those credits were from checks that were written. So there's the company's accounting of the checkbook for May. So according to our accounting system back at the company, the balance in cash is $15,177.30. Now the bank is keeping track of the same thing as we are. So the bank thinks that our balance is $21,762.70. We think our balance is $15,177.30. They don't agree. If we're keeping track of the same thing, they should agree. Why don't they agree? We're missing stuff. Either the bank's missing stuff that they're not aware of, or we're missing stuff that we're not aware of. So we have to perform a reconciliation. So let's take a look and see how this ends up. So let's focus on the left side. Here's the bank. The bank statement balance at the end of May, and that's what we're looking at, $21,762.70. Now, what we're doing during this process, remember, is trying to find out what the bank doesn't have recorded, doesn't have on their bank statement yet, that we do in our bank account. So in our lecture, they gave us total amounts. Now we're going to find those amounts. How do we do that? Well, since we're trying to find stuff that's missing on the bank statement, we have to compare it to something. And we're going to compare it to our cash receipts deposited cash debit column of our own records. On May 4th, we have listed a deposit of $24.38. That's right below our bank statement. On our bank statement, there's a deposit of $24.38. So I'm going to put a little check mark next to each one. So that says not only is it on the bank statement, but it's also recorded as a deposit in our checkbook. It's not missing. Now I'm going to look at our next deposit in our checkbook, which is $28.98. Oh, the bank also has that up on the bank statement. So I'm going to put a little check mark next to that. In our records, it says, so from Shamara Systems accounting records, cash debit 22nd, 1801.80. It's up on the bank statement as well. Great. Next deposit, May 26, $2,000.79, or I'm sorry, $2,079. That's also on the bank statement. Now, if you're sitting there going, wait, there's another deposit on the bank statement. Yep, I know, but we're not looking at that right now. We're just verifying, are all the deposits in our checkbook at Shamara's on the bank statement? And so far they are. The last one on May 31st, the $27.27.30, is not on the bank statement. So, and it's usually because of timing. Remember, we talked about this deposit might have been made after the cutoff time for transactions on May 31st. So it's not that it's not going to be deposited, it just isn't on the May 31st bank statement. So it should have been. So we're going to add that deposit in transit. It should have been on the bank statement, and if it was, our bank statement would have been 2727.30 higher. Now let's go over, so we've accounted for all of our deposits on our checking records, checking account records. Now we're going to go to the cash payments. Remember, they're all checks there, 1782, 83, 84, 85, 86, 87, 88, 89. All right, let's see if they are all on the bank statement. 1782, we're going to verify not only the check number, but also the dollar amount, 1285.50. Yes, I see it there. I'm going to click it off on both spots. Checks 1783 for 382.50. Yep, and it's cash for the proper amount. It's up on the bank statement. Check 1784 for 1449.60. 1449.60. Yep, that's on the bank statement. So it's not missing from either place. Check 1785 for 63.90. Yep, and yep. Check 1786 for 353.10. Nope. So that one is missing. So I'm going to put a little circle around that. 1787 for 8,032.50. Yep, and yep. Check 1788 for $644. Oh, 1788 is cashed, but it's cashed for $654. So I'm going to put a little asterisk there. I'm going to have to find out, did the bank cash it for the wrong amount or did we? Oh, wait. I'm going to go to page 322 before I continue my process. And it says, check number 1788 is correctly drawn for $654. It was used to pay May utilities. The bookkeeper misread the amount and entered the wrong amount in our checkbook. So we're going to have to fix that, but not right now. So the bank did correctly cash this for $654. So this is not a bank error. They did the right thing. Check 1789 for $639.50. I'm not seeing that either, so I'm going to circle that. Now I'm looking at my bank deposit and I'm remembering they told me some information, or my bank statement, I mean, and I'm looking up in the top and it said, oh, going into the month of May, there were 2 checks that weren't cashed yet. Check 1771 for $781. Well, if you look at your bank statement, that one was cashed. So that is no longer outstanding. So I'm going to put a line through it. But check 1780, that is still an outstanding check from the prior month. So it's still considered outstanding. It should have been cashed. It hasn't been. Well, let's subtract these checks that haven't been cashed yet. 1780 for $1429.25.90, 1786 for $353.10, and check 1789 for $639.50. They are missing from our bank statement. They should have been cashed, but because of timing, they haven't been. So subtract them. So if the bank did have that deposit in transit and cashed all the checks they should have, our bank statement would have said $22,071.50. So we just reconciled the bank statement balance. Now, if we're at this point, we could look at that adjusted bank balance and compare it to our checking account balance back at the company. It still doesn't agree. The book balance is still at $15,177.30. Yikes. So that must mean there's stuff on the bank statement that we haven't recorded yet in our checkbook. So let's find those things. Now, if you go to the deposits, and here's what you're going to do. You're going to go from the deposits on the bank statement to the deposits in your checkbook. And if you look, all the deposits in your checkbook already have little marks next to them. Remember I said check them off as you compare them and they agree with each other? The only item that isn't in our checkbook is the May 25th CM for $73.50. And that's just a credit memo. We're going to need to know more information. And if you go to page 322, They tell us in Part C, the very last sentence, the credit memorandum is from a 7350 note that the bank collected for the company. The collection has not been recorded yet by the company. Now it will be. So somebody went into our bank and said, put that in Shamara's checking account for me. I'm paying off a bill I owe them. And that's what that represents. We just didn't know about it at the company. If we did, we would have debited cash, right? Now we're finding out about it. That's the only deposit on our bank statement that is not currently in our checkbook. We're going to do the same thing with our checks and debits from our bank statement. Now, most of these items we've already verified that they are in our checkbook. The one item we haven't is the NSF for $431.80. That has not been deducted from our checkbook. Remember, that is a customer's check bouncing. So we need to subtract that now, the $431.80. The other item not in our checkbook yet is the $14 service charge, SC, on May 31st. Let's subtract it now. It should have been subtracted from our checkbook balance. And the final item is that check we have the little asterisk next to, check 1788. Remember, the bookkeeper only deducted $644. They should have deducted $654. So now we're going to have to deduct the additional $10 to correct the checkbook balance. So once we add the missing deposit that the bank had is on the bank statement, but we don't have in our checkbook yet, and the deductions that the bank has deducted from our bank statement, but we don't have deducted in our checkbook yet, then our adjusted book balance does agree to our adjusted bank balance because we found the missing items from each independent recorder of our checking account, added and subtract those missing items, and now the balances agree. So the correct balance in our cash account is not $15,177.30, but $22,000. Whoops, I keep inverting numbers today. $22,071.50. So we're not done yet. Remember we said we're not dealing with our personal checkbook. If we were, we would be like, yay-ha, we got $22,071.50. Let's keep going. But we're not. We're dealing with a company, and a company has an accounting system that they keep it very organized and use journal entries. So now we have to record any item that was missing from our checkbook. So we're focused over here. So we're going to debit cash for $73.50, credit notes payable for the receipt on that note that was paid off. The NSF check, we have to decrease cash, so there's our credit to cash. We increase accounts receivable. They still owe us the money, and on page 322, they tell us in Part B that the NSF check and the statement was originally received from a customer, W. Sox, in payment of her account. Okay, so we want to now put it back into accounts receivable. W. Sox still owes us that money. The $14 service charge we debit to miscellaneous expense and credit to cash. And then the error. Well, we got to find out what the original check was for. And they tell us in Part A, the check was to pay May's utilities. And the original journal entry debited utilities expense and credited cash for the incorrect amount of $644 or $644. It should have been $654. So now we'll debit utilities expense and credit cash for that additional $10. Now, if we take a few seconds, and I don't have a T account here, but put one on a paper. $15,177.30 on the debit side. Now, each item that affects cash in our journal entries. Okay, debit cash $73.50. Credit cash $431.80. Credit cash $14 and credit cash $10. Add up your debits, add up your credits, subtract the credits from the debits. The new balance in your cash account is $22,071.50. So this is a activity that a company does every month to make sure they're keeping track of the checkbook correctly, and the bank is, and updating it for missing items. It's a very important part of internal controls. And as I said, it should be done monthly. You should do your personal checkbook monthly. And when I hear people say, we're not going to use information from this class ever, in business you will. And then this you can use in your personal life every month, and you should. So if you have any questions, please post them to the discussion board.